Welcome to the Maybe Not So Great Books channel, You Decide. This is lesson 1 of 14, the only definition of investing that matters, from The Intelligent Investor, the definitive book on value investing by Benjamin Graham, commentary by Jason Zweig. What if everything you think you know about investing is actually just speculation with a fancier name?
That's exactly the question we need to start with today. Because it's the heaviest lift of the entire book.
Yeah, I have to be honest with you. I read the intro to this deep dive. I read the chapter, and I feel a little bit, I feel attacked.
Attacked? Why do you feel personally victimized by a book written in 1949?
I do, because this prompt basically questions my entire financial existence. I mean, I'm sitting here looking at my brokerage app, or I'm looking at some crypto I bought last year because a guest we had mentioned it. I'm looking at a tech stock I bought because my brother-in-law said it was going to the moon.
Right.
And I'm thinking, am I the target audience for this attack? Because I really thought I was an investor. I felt like an investor.
Well, we're all the target audience. That's the beauty of Benjamin Graham. He really doesn't care about your brother-in-law's hot tip. He doesn't care about the chart you saw on Twitter or whatever. He cares about definitions.
Yeah.
And the definition we are covering today, which, by the way, was actually written in 1934 before being adapted into this book, it's basically a litmus test.
A litmus test for what, exactly? To see if I'm, smart or stupid?
No, not smart or stupid. A litmus test for reality.
No.
Graham draws a line in the sand. A very bright, completely non-negotiable line. On one side, you have investment. On the other side, you have speculation. And he is incredibly strict about it. There's no gray area.
None at all.
None. There's no such thing as investing for fun. There is no investing because you have a hunch.
See, that's where I get hung up. Because if I stop 10 people on the street right now and ask them, hey, what is investing? 9 of them are going to say it's buying an asset.
Right.
Buying a stock, buying a house, buying Bitcoin. If I put money into it and buy it, I am investing in it.
Exactly. That is the common usage of the word today.
And you're telling me Graham disagrees with that fundamental premise?
Vehemently. To Graham, buying a stock is a completely neutral act. It's like buying a car. You can buy a car because you've analyzed the fuel efficiency, the resale value, the maintenance cost, the safety rating. That is an investment in transportation.
Okay.
Or you can buy a car because it's bright red, it goes 200 miles an hour, and it makes you look cool, even though you can't actually afford the insurance. The act is the exact same. You bought a car, but the process behind it is entirely different.
So the asset itself doesn't bestow the title of investor on you. Just owning a share of Apple doesn't magically make me an investor.
No. And this is exactly where people get into trouble. They buy a blue chip stock, say Microsoft or Coca-Cola, and they think, well, I bought a safe stock, therefore I am investing.
Which feels logical.
It feels logical, but Graham says, not necessarily. If you overpaid for it, you're speculating.
Yeah.
If you didn't check the balance sheet, you're speculating. If you bought it just because the price was going up last week, you're definitely speculating.
Okay, I'm ready to take my medicine here. Let's look at this actual definition. It's from the 1934 edition of Security Analysis, which is sort of like the prequel to The Intelligent Investor. I want to read it slowly because I feel like every single word is doing heavy lifting.
It absolutely is.
Yeah.
This is probably the most carefully constructed sentence in financial history.
Okay, he writes, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative.
Operations not meeting these requirements are speculative.
That is just incredibly rigid. Operations not meeting these requirements, it sounds like a legal statute. It doesn't say they're risky. It doesn't say they're ill-advised. It says they are speculative.
Exactly. And look at the first 3 words again. An investment operation.
Operation. Yeah, that's an interesting word choice. It sounds like surgery. Or, I don't know, a military maneuver.
Right, because it implies a process.
Yeah.
It implies work. Most people think of investing as an event. I click buy, that's an event. An operation implies a set of actions you take before and during the ownership. It's an active process, not a passive one.
Okay, so let's break down the 3 mandatory requirements. Because if I miss even one of these, apparently I'm just a gambler in a suit.
That's right.
Requirement 1, thorough analysis. Requirement 2, safety of principal. Requirement 3, an adequate return.
Let's start with thorough analysis.
Because in 2026, thorough analysis usually means I watched a TikTok video, I read 3 comments on a Reddit thread, and maybe I looked at a chart for 15 seconds.
And Graham would say, that is entertainment, not analysis.
So what does legitimate, Graham-approved, thorough analysis look like? He uses this phrase, I think investment is most intelligent when it is most businesslike.
Yes, businesslike. That word is the key to unlocking this whole concept.
I want to use an analogy here because it helps me visualize it. Let's talk about the pizza shop down the street.
Okay.
Let's say I want to buy Luigi's Pizza. Not shares of it on an app, but I want to buy the physical whole place. I'm walking in to sign the contract to take over the business.
Okay, perfect. You are the buyer. You're going to be the owner of Luigi's.
Now, if I'm a speculator, which is the way most people buy stocks, I walk in and I say, hey, Luigi, I saw a line out the door yesterday. The pizza smells amazing. Here is $1 million.
Exactly. You're buying the buzz. You're buying the momentum. Your logic is the line is long, therefore the business is booming, therefore it's worth whatever you're asking.
But if I'm an intelligent investor doing thorough analysis, I am not even looking at the line out the door yet. I'm looking at the books. What specifically am I looking for in the kitchen?
First, you're looking at assets versus liabilities.
Yeah.
You go into that kitchen. Do you actually own these ovens?
Yeah.
Or does the bank own them?
Right. Is there a lien on the pepperoni slicer?
Exactly. Graham was absolutely obsessed with tangible assets. If Luigi goes bust tomorrow, what can I sell the ovens for? What is the real estate worth? That is your book value. If you pay $1 million for the shop, but the ovens in the building are only worth $10,000, you have almost no asset protection. You're paying purely for goodwill or future hopes.
Okay, so step one is figuring out what the junk is actually worth if we had to sell it at a yard sale. What's step two?
Earnings consistency. Not just, did you make money last week during the Super Bowl rush? Graham wants to see the last 5 to 10 years. Did Luigi make money when flour got expensive? Did he make money during the pandemic? Did he make money when the city was doing road construction out front?
So I'm looking for stability. I want to know this business generates cash in all seasons, good and bad.
You're looking for absolute proof that the business works in different economic environments. And then crucially, you look at the margins.
Okay, explain margins to me like I'm 5. Because I hear gross margin and operating margin on CNBC and my eyes just completely glaze over.
It's very simple. If Luigi sells a slice of pizza for $3, how much did it actually cost him to make it? That includes the dough, the cheese, the electricity for the oven, the hourly wage of the guy spinning the dough. If it costs him $2.90 to make that slice, he has a dime of profit. That is a razor-thin margin.
That sounds incredibly dangerous.
It is. Because if wholesale cheese prices go up by 15 cents, suddenly it costs him $3.05 to make the slice. He is literally losing money on every single sale. He's underwater.
But if it costs him, say, 50 cents to make that $3 slice,
Then he has a massive margin of safety. He can survive inflation. He can survive a bad month where foot traffic is low. He can survive his landlord hiking the rent. Graham wants to see high margins because they provide, before it, safety.
Safety of principle, it all connects back to the definition.
It all connects. Now, bring this back to the stock market. When you buy a share of Apple or Nvidia or whatever random penny stock your brother-in-law pitched you, do you know their profit margin? Do you know their long-term debt load? Do you know their earnings stability over the last decade?
Honestly, most people just know the stock price went up yesterday.
Then they are buying the line out the door at the pizza shop. They are not buying the business in the kitchen. They are speculating.
Okay, that makes so much sense. That covers thorough analysis. It's treating the stock like a private business you are buying 100% of. Now let's move to the second requirement, safety of principle.
This is the one that trips people up the most, I think.
Because safety sounds like risk-free.
Yeah.
And if I want absolute safety, I'll just put my money in a high-yield savings account or stuff it under my mattress. But even that isn't truly safe because of inflation, right?
Precisely. If you bury a $100 bill in your backyard, you have 100% safety of the nominal principal.
Yeah.
You put in 100, you dig up 100. But in 10 years, that $100 buys half as much pizza. So you've actually lost purchasing power. Graham understands this.
So what does he actually mean by safety of principle in the stock market, where prices are literally jumping up and down every second of the day?
He means protection against permanent loss under normal conditions. He's really talking about the mathematical reality of recovery.
The math of recovery.
Let's do some quick math.
Yeah.
Let's say you invest $1,000 and the stock drops and you lose 50% of it. You now have $500 left. What percentage gain do you need to get back to your original 1,000?
Well, if I lost 50%, I need to make 50% back, right?
No. And this is the psychological trap. If you have $500 and you make a 50% return on that, you only made $250. You now have $750. You are still down. To turn $500 back into $1,000, you need a 100% gain.
Oh, wow. Right. The hole is twice as deep as the fall.
Exactly. Losses are wildly asymmetrical. A 50% loss requires a 100% gain just to get back to zero. A 90% loss, that requires a 900% gain just to break even. Graham was obsessed with safety of principle because he knew that once you lose a significant chunk of your capital, the math works against you so aggressively that you might never recover in your lifetime.
So safety isn't the price never dips. It's I bought at a price where a permanent 50% loss is mathematically unlikely.
Yes, it is all about the margin of safety. If a business is worth $1, truly worth $1 based on those ovens and margins we just talked about, and you manage to buy it for 60 cents, you have a 40-cent safety buffer. Even if your analysis is slightly wrong, you probably won't lose much money. But if you pay $1.50 for that $1 business,
then you have negative safety.
You have zero safety of principle. You are relying entirely on a miracle or a greater fool coming along to pay $2.
Which brings us to the third requirement, an adequate return.
Note the specific word he chose, adequate.
I did note that it feels underwhelming. I don't want an adequate life. I want a spectacular life. I want life-changing wealth. Isn't that the whole point of investing?
That is what speculation is for. The speculator is utterly obsessed with the upside. They want the moonshot. They want to turn $1,000 into $100,000 overnight.
Which we all want, don't we?
Sure, we all want it, but actively pursuing it usually leads to ruin. Because to get that 100x return, you have to take risks that completely violate safety of principle. You have to buy the financial equivalent of a lottery ticket. And what happens to almost all lottery tickets?
They end up in the trash.
Right. The investor, according to Graham, targets an adequate return. A return that compensates them fairly for their risk and their effort, but is mathematically sustainable. The investor is obsessed with the downside. The speculator is obsessed with the upside.
So the investor asks, what can I lose? And the speculator asks, what can I make?
Precisely. And Graham warns that the most dangerous person in the market isn't the gambler who knows he's gambling. I mean, I can go to Vegas, put $100 on red, and I know I'm gambling. I'm having a good time. I fully expect to lose that money.
Right. It's an entertainment expense.
But the truly dangerous person is the speculator who thinks he is investing. The person who takes their life savings and puts it into a wildly volatile tech stock or a new crypto token, thinking, this is my retirement plan. When in reality, they are just spinning the roulette wheel. That is the exact cause for concern Graham was warning us about. That's where lives get completely ruined.
Speaking of lives getting ruined, I really think we need to talk about why Graham was so obsessed with this. Because reading this, you might think he was just a grumpy old academic professor trying to rain on everyone's parade. But he had serious scars.
Deep, deep traumatic scars. This definition wasn't just some academic theory for him. It was a literal defense mechanism against poverty.
Let's tell the story of the panic of 1907, because this is really the origin story of the intelligent investor.
It really is. So Benjamin Graham was actually born Benjamin Grossbaum. He came from a fairly affluent family. They lived in a nice brownstone in New York. They had household staff. They ran a successful business importing fine china and ceramics.
So he started on third base, basically.
He did. But then his father died very suddenly when Ben was only 8 years old.
That's devastating.
It was. And the family business quickly collapsed without the father running it. So his mother, Dora Grossbaum, was left totally alone with the children at a rapidly dwindling family fortune. And she did what a lot of people do when they feel desperate to recover their lost status.
Yeah.
She looked for a quick fix. She looked to the stock market.
She started speculating.
She did. She opened a margin account. And we really need to explain what that means because it's so crucial to understanding the safety of principle concept.
Margin is basically borrowing money from your broker to buy more stock, right?
Let's say you have $10,000. You could borrow another $10,000 from the broker, and now you can buy $20,000 worth of stock.
Which sounds amazing, because if the stock goes up 10%, I make double the profit I would have.
Exactly. Leverage amplifies your gains. But the trap is, it also amplifies your losses. If that stock drops 10%, you don't lose 10% of your money, you lose 20% of your money. And if the stock drops 50%,
you are totally wiped out.
You are at zero. Your equity is gone. And that is exactly what happened to Dora Grossbaum. She was trading U.S. steel on margin. And then the panic of 1907 hit. It was a massive, brutal financial crisis. Banks were failing, liquidity just completely dried up overnight, and the market crashed.
And because she was on margin.
She wasn't just down on her investment, she was forcibly liquidated. The broker sold her positions at the absolute bottom just to cover the loan they made to her. The family went from living in a beautiful brownstone with servants to essentially outright poverty. And little Benjamin Graham watched all of this happen. He was a very smart kid. He felt the humiliation of it. He watched his mother have to turn their house into a boarding house just to make ends meet.
Wow, so he saw firsthand how speculation can just instantly destroy a family's security.
He did. So when he writes, operations not meeting these requirements are speculative, he's literally remembering his mother losing everything on U.S. Steel. When he demands safety of principle, he means it viscerally. He means do not ever put your family in a position where a market crash takes away your dinner.
That adds so much incredible weight to the words. It's not just financial theory, it's actual survival.
It is survival.
Yeah.
And he spent the rest of his life trying to build this mathematical fortress that would prevent that scenario from ever happening again to anyone who followed his rules.
But let's fast forward a little bit, because a listener right now might be saying, well, that was 1907, we have the SEC now, we have regulations, circuit breakers, the markets are totally different. But Graham gives us these incredible examples from much later in his career that show this human tendency, this primal desire to gamble. It never actually goes away. I want to talk about AAA Enterprises.
Oh, yes. The Count to Three case study. It's from chapter 17, and it is brilliant.
Before we even get to the specific company, let's explain Graham's insult here. Because he says the speculative public is incorrigible. In financial terms, it cannot count beyond 3.
It's such a beautifully brutal takedown. Cannot count beyond 3.
What exactly does he mean by that?
He means the average person's entire thought process in the market is literally just 3 steps. 1, buy stock. 2, price goes up. 3, profit. That's it. That is the absolute extent of their financial calculation. They see action, they see movement, they see a ticker symbol blinking green on a screen, and they think, well, if I get in right now, I can get out higher tomorrow.
They're just betting on the greater fool theory.
Yes. They aren't looking at the business, they're just counting to 3. And AAA Enterprises is the absolute perfect historical example of this.
To set the scene for us, it's 1969.
The year is 1969, and the massive buzzword of the day in the market was franchising. It was exactly like AI is today or what .com was in 1999. If you had the word franchising anywhere in your business plan, investors just went completely crazy for it.
So enter this guy, Mr. Williams. A college student, right?
A college student who somehow starts a mobile home business. Now, traditionally, selling mobile homes is a really tough, low-margin business. You have physical inventory sitting on lots, you have bad consumer loans. It's really not sexy at all. But Williams comes along and says, no, I'm not selling mobile homes. I am selling franchises for other people to sell mobile homes.
He even had a tax prep franchise, didn't he? Called Mr. Tax of America.
Mr. Tax of America.
Ah.
You literally cannot make this up. It sounds like a fake company from a cartoon.
But the stock market took it incredibly seriously.
Oh, they loved it. The company goes public. The stock is initially offered at $13 a share. And purely because of the franchising buzzword, it almost immediately doubles to $28.
So the speculators are looking at this and seeing, 1, buy stock. 2, price goes up. 3, profit.
They are counting to 3 perfectly. But let's actually do the thorough analysis that Graham demands. At $28 a share, the stock market was valuing this mobile home company at about $84 million.
Well, $84 million. In 1969 money. That is a massive valuation.
It is huge. But here is where the analysis kicks in. If you bother to look at their 10K financial filing, which anyone could do, it was public record, but basically nobody did, you would see that their reported earnings were, well, let's call them extremely creative.
Creative how?
Well, when they sold a franchise to someone for, let's say, $10,000, that person rarely paid cash up front. Instead, they signed a promissory note, basically an IOU saying, I will pay you this $10,000 over the next 5 years.
Okay, pretty standard.
But AAA Enterprises would book that full $10,000 as revenue today, even though they hadn't actually received a single dime of cash in the bank.
Wait, was that even legal?
In 1969, it was a very gray area of accounting. But from a safety of principle standpoint, it's an absolute disaster. You are reporting massive profits to Wall Street that literally do not exist in your bank account. You cannot pay your corporate electric bill with a promissory note from a franchisee.
So the smart, defensive investor looks at the cash flow statement and sees, wait, reported profit is high, but actual cash is 0. Huge red flag.
A blindingly red flag. But nobody looked. They just saw the headline earnings number in the newspaper. And here's the craziest part. Even using those fake inflated earnings, the stock was trading at 115 times earnings.
Let's pause on that. 115 times earnings. Because we hear PE ratios all the time today. Nvidia is trading at 70 times, Tesla is at 50 times. Why is a multiple of 115 so dangerous? Explain the actual math of that to me.
Think of the PE ratio, the price to earnings ratio, as years to pay back. If you buy a local coffee shop down the street for $100,000 and it makes $10,000 a year in pure profit, your PE is 10. It takes 10 years of those earnings for you to get your initial purchase price back.
Okay, that makes total sense. 10 years feels like a reasonable payback period for a private business.
Right. Now imagine buying that exact same coffee shop for $1.5 million, but it still only makes that same $10,000 a year.
It would take me 115 years to break even.
Exactly. You would literally need to live to be 150 years old just to get your money back. And that's assuming the coffee shop never has a single bad year, never needs a new espresso machine, and coffee doesn't suddenly go out of style.
That is insane. When you put it in terms of human years, it just sounds utterly ridiculous to pay that much.
It is ridiculous, and that is exactly why Graham calls it speculation. You aren't investing in the actual earnings of the business. You can't be, because the earnings won't pay you back until the year 2084. You are strictly betting that a greater fool is going to come along tomorrow and pay you 200 times earnings so you could escape.
And with AAA Enterprises, the greater fool just never showed up.
No, they didn't. The inevitable cash crunch hit. They couldn't pay their bills because their profits were just a pile of IOUs. Within 2 short years, the company burned through all its cash and filed for bankruptcy. The stock went from $28 straight to zero.
Zero.
The people who bought in at 28 sincerely thought they were investing in a high-growth company. Graham says, no, you were speculating on a buzzword. They completely ignored the math. And because they ignored the math, they lost 100% of their principal.
Well, it's brutal. But okay, I can hear people saying, sure, that's a sketchy mobile home startup. What about blue chip stocks? What about giant safe companies? Graham has a story about that too, right? Penn Central.
Yes, and this is the even more important lesson, honestly. Because AAA Enterprises look like a gamble to anyone paying attention, but Penn Central looked like an absolute fortress.
Right. Penn Central was the largest railroad in the United States, a massive, historic institution.
Massive. In 1968, the stock was trading at 86.5. It was universally considered a conservative, rock-solid investment. Widows and orphans owned this stock for the dividend. It was a classic blue chip.
So where was the failure of thorough analysis here?
Well, Graham points out something fascinatingly simple. If you looked at their financial statements, you would see they reported massive profits. But if you look just a tiny bit closer, using what Graham calls elementary arithmetic, you would see something extremely strange about their tax bill.
Their tax bill?
Yes. They hadn't paid any actual income tax in 11 years.
Wait, the biggest railroad in the country hadn't paid taxes in over a decade?
No. And ask yourself, why doesn't a highly profitable American company pay income tax?
Because they aren't actually making any real money.
Bingo. The IRS always expects its cut. If you tell your shareholders you made a massive profit, but you tell the IRS you didn't make a dime, always trust the IRS version of the story. Penn Central was using incredibly complex accounting tricks to show phantom profits to keep their stock price elevated, while the actual underlying railroad business was rotting away from the inside.
So the thorough analysis there would have been just, look at the tax line item, it's zero. Why is it zero? Oh, because they have no real earnings.
Exactly. But people just didn't look. They saw the name Penn Central, they saw railroad, they saw blue chip, they assumed it was safe by reputation, and they counted to 3.
And what happened to them?
They went bankrupt in 1970. It was the largest corporate bankruptcy in American history at the time. The stock that traded at 86.5 basically went to zero.
So even buying a boring, massive, famous company can be pure speculation if you don't actually check the numbers yourself.
Yes. Blue chip is just a marketing label. It is not a guarantee of safety. Safety comes from the mathematical relationship between the price you pay and the value you get, not from the brand name on the building.
You know, this feels incredibly relevant to today. I mean, we are living in a world of algorithmic trading, crypto, 24-hour markets on our phones. Does a strict definition from 1934 really hold up when I can buy a fraction of a Bitcoin at 3 in the morning while sitting in bed?
I would argue it is significantly more relevant today, precisely because the tools of speculation are so much easier to access. In 1934, you had to physically call a human broker on a telephone to place a trade. You had to pay a massive commission. There was friction. Now the friction is completely gone. Apps have gamified the experience with confetti graphics. You can speculate your life savings away while waiting in line for your morning coffee.
Let's look at some modern examples through Graham's lens then. We absolutely have to talk about the meme stock craze of 2021. GameStop, AMC.
That is the perfect modern example. Let's run GameStop through Graham's definition.
Okay, requirement 1. Thorough analysis.
Were people analyzing the underlying business of selling physical video game discs in strip malls during a digital era? No. That business was clearly declining. They were analyzing the short interest on the stock, they saw that hedge funds had heavily bet against it, and they decided to coordinate and squeeze them.
Right. It was all about diamond hands, apes together strong, taking it to the moon.
Exactly. That is highly emotional tribal language. It is not analytical language. Graham's concept of Mr. Market literally became a Reddit thread in that scenario. There was zero safety of principal buying GameStop at $300 or $400 a share. The business fundamentals, the real book value, the actual cash flows, couldn't even support a tiny fraction of that price.
But people will say, hey, I made millions on it.
And some people did make millions. The ones who got in early and managed to get out at the exact top. But for every one person who became a millionaire on GameStop, there are 1,000 people who bought at $300 and eventually sold at $20 when reality set in. That is the very nature of speculation. It transfers wealth from the latecomers to the early birds. Investing creates new wealth through actual business growth. Speculation just violently shuffles existing wealth around.
What about SPACs, special purpose acquisition companies? We saw a massive boom of these in 2020 and 2021. Everybody had one.
SPACs are arguably the purest form of speculation, packaged up and sold as early access. You are literally handing your money over to a sponsor. It's basically a blank check and just hoping they manage to find a good private company to buy with it later.
You don't even know what company they're going to buy when you invest.
Right, so you have no business to analyze. You absolutely cannot perform thorough analysis on a blank check. You cannot calculate safety of principal because there's zero assets and zero earnings history yet. It fails Graham's definition instantly. Yet, billions and billions of retail dollars flowed into them. Why? Because people were counting to 3. SPACs are hot, buy SPAC, profit.
And so many of those SPACs are down 90% or more now.
Exactly. Graham's 1934 definition perfectly predicted that 2021 outcome.
I want to touch on crypto too. And I know this is a controversial topic. People get very defensive and angry when you call crypto speculation. But strictly speaking, looking objectively at Graham's definition.
If we look strictly at his 3 rules, safety of principal based on thorough analysis of adequate returns. Let's look at Bitcoin. Does it have a book value? No. There are no physical factories or pizza ovens to liquidate. Does it have earnings? No. It doesn't produce any internal cash flow.
So you basically can't value it.
You can price it based on supply and demand, but you cannot value it mathematically. You can't say Bitcoin is intrinsically worth $50,000 because it produces $2,000 of cash flow per coin. It produces nothing. Its value is entirely based on the belief that someone else will pay more for it tomorrow.
So by Graham's strict definition, it is definitively a speculative instrument.
Yes. But to be clear, Graham wouldn't necessarily say don't ever buy it. He would say admit to yourself that you are speculating. Don't put your mortgage money or your kid's college fund into it thinking it is a safe, wealth-preserving investment. It is a speculation on future mass adoption.
That distinction between don't do it at all and just know what you are doing seems really critical here.
It is everything. Jason Zweig, who wrote the modern commentary for this edition, has a brilliant quote. He says, "The real risk resides not in what kinds of investments you have, but in what kind of investor you are."
Meaning the danger isn't necessarily the asset itself, it's the delusion of the person holding it.
Right. If you have 2% of your net worth in crypto and you explicitly say, this is my lottery ticket, if it goes to 0, my life doesn't change.
Yeah.
That is intelligent speculation. But if you put 50% of your net worth in it and tell yourself, this is totally safe because it's the future of money, you are delusional. And the market historically punishes delusion with extreme prejudice.
I want to play devil's advocate here for a second, because this definition, safety of principle, thorough analysis, it sounds great, it sounds incredibly responsible, but isn't it paralyzing?
How so?
Well, if I demand absolute safety of principle before I buy anything, can I ever actually buy a stock? Don't all stocks inherently have risk? If I followed this 1934 rule perfectly, wouldn't I just own short-term treasury bills my entire life? If I sit around waiting for the perfect book value bargain, I might miss out on the next Amazon. I might miss out on Google.
That is a very fair challenge. If you interpret safety as meaning literally no risk of downward price movement, then yes, you would never buy a single stock. But Graham acknowledges that all investing involves some level of risk. He means safety in a probabilistic sense. Are the mathematical odds of permanent loss low? Is the purchase price low enough compared to the real value to offer a buffer if things go wrong? He means reasonable safety based on hard data, not a magically guaranteed safety.
So it's about making sure the casino odds are heavily in your favor before you sit at the table.
Right, the casino has safety of principle even though they lose individual hands of blackjack to tourists every single night. They have the mathematical edge over thousands of hands. Graham wants you to operate like the casino, not the tourist.
But there is a huge glaring contradiction in Graham's own life, isn't there? I mean, we have to talk about the elephant in the room, GEICO.
Ah, yes, the GEICO Paradox. This is genuinely one of my favorite parts of Graham's story because it just makes him so human.
So tell us the GEICO story. Because Graham is known as the safety first guy, the diversify broadly guy, the buy cheap cigar butt stocks guy.
Right. Throughout his book, he constantly preaches diversification. Own 10 to 30 stocks. Don't put too much capital in one basket. But in 1948, his investment fund, Graham Newman, bought 50% of a little company called GEICO Government Employees Insurance Company.
50% of the whole company.
Yes. And the cost was about $712,000, which meant that one single position represented roughly 25% of their entire fund's assets.
Oh, 25% in one stock. That breaks literally every diversification rule he just wrote in the book.
It absolutely does. And furthermore, GEICO's was fundamentally a growth company. It was priced significantly higher than his typical deep value bargain bin stocks. It wasn't a cheap cigar butt. It was a massive bet on a disruptive business model.
So he was speculating by his own rigid definition.
You could definitely argue that. Or you could argue he saw a completely different kind of safety derived from the quality and dominance of the business franchise, rather than just statistical cheapness. But here is the real kicker of the story. That GEICO investment grew, and it grew, and it grew. By 1972, that original stake was worth about $400 million.
$400 million from $712,000.
It made more money than all of his other thoroughly analyzed, perfectly safe, widely diversified investments combined over his entire 20-year career.
That is just mind-blowing. The guy who literally wrote the Bible on conservative diversification made almost all of his actual wealth on one aggressively concentrated bet.
And Graham is fully transparent about this. He actually admits it in the postscript of the book. He says, ironically enough, the aggregate of profits accruing from this single investment decision far exceeded the sum of all the others.
So does this invalidate his whole definition? Does it mean we should all just ignore the rules and try to bet big on finding the next GEICO? Does it mean the safety definition is just for chumps?
That is the exact dangerous takeaway you want to avoid. Graham specifically calls it one lucky break, or one supremely shrewd decision. The real expert insight here is that GEICO was the massive exception, not the rule. If Graham had only spent his career chasing long-shot GEICOs, he might have gone completely broke, just like he almost did during the 1929 market crash. The rigid safety rules are what kept him in the game long enough to actually find and hold the GEICO opportunity.
I see. So the rigorous, boring definition is what keeps you alive and solvent. The lucky break is what eventually makes you rich, but you absolutely cannot bank on the lucky rich. You have to bank on staying alive.
Exactly. And for the average listener, for you and me, Graham's strict definition is infinitely safer than trying to blindly find the next GEICO. Because for every one GEICO that goes to the moon, there are 100 AAA enterprises that go straight to zero.
That makes perfect sense. And Graham does talk about intelligent speculation, doesn't he? He fully admits people are going to speculate. He knows it's human nature to want to play the game, so he actually gives some rules for how to do it without destroying your life.
He does. He says, look, speculation is basically unavoidable. But if you feel you simply must do it, follow these rules. 1. Explicitly know you are speculating. Do not lie to yourself and call it investing. 2. Keep it strictly to a separate small account. He calls it a mad money account. Maybe 5% of your total assets. And 3, never, ever mix your speculative money with your investment money. Don't let your gambling habits slowly bleed into your core retirement savings.
That concept of mental accounting seems incredibly crucial. Just saying, this is my Vegas fund. If I lose it, it's fine. but my retirement is locked away in the safety zone.
Correct. It essentially contains the blast radius of a bad emotional decision.
I want to zoom out a bit to a broader debate.
Yeah.
Because there's a very common criticism of Graham that his bright line between investing and speculating is just too old school for the modern intangible economy.
Sure, I hear that all the time.
Think about venture capital, right? Startups. By Graham's strict definition, investing in a seed stage tech startup is pure speculation. There is zero thorough analysis of past earnings because there are no past earnings. There is zero safety of principal because 90% of all startups completely fail.
That's entirely true. By Graham's rulebook, all early-stage venture capital is speculation.
But VC fuels the entire modern economy. It builds the Googles, the Ubers, the Airbnbs. Is Graham really calling all of that incredible innovation gambling?
I think he would absolutely accept that label. But he wouldn't say it's inherently bad for society. He would say this is a high-risk economic activity where you mathematically expect most of your positions to fail in exchange for one massive portfolio-making winner. That fundamentally fits the mechanics of speculation.
Right, it's a different game.
Exactly. The problem isn't that professional VCs do it. They are professionals managing huge, diversified portfolios of these risky bets for institutional clients. They operate like the casino. The problem happens when a regular retail investor treats a highly speculative asset, like an IPO trading at 100 times earnings, or a random crypto token, as if it is a safe savings account for their kid's college fund.
So the binary investment versus speculation, it isn't about judging the innovation itself. It's really about protecting the defensive investor from themselves.
Exactly. It is fundamentally an ultimate form of consumer protection. You have to ask yourself, are you completely comfortable admitting that your high-growth tech portfolio is actually a speculation portfolio? If that label scares you, if you think, wait, I definitely can't afford to speculate with this money, I need this to retire, then you are dangerously overexposed. You need to move your capital back to safety.
That is such a powerful reframing. It's not about the asset being evil or bad. It's about the specific role that money plays in your life.
Yes, context is everything.
Okay, we have covered the definition, the history with his mother, the crazy math of PE ratios, and the modern applications. Now, really want to get practical. It's Monday morning. The listener is sitting at their computer looking at their brokerage account. What do they actually do with all this 1934 theory?
I love this part. We have to bridge the historical theory to actual action. I highly suggest everyone do a portfolio audit.
A portfolio audit. Okay, step by step, how do we actually execute that?
Step 1. Export your entire current portfolio to a spreadsheet, or just write it down on a piece of paper if you prefer.
Okay, simple enough.
Step 2. Create a blank column next to each ticker symbol and call it classification.
And what are the options for that column?
Just 2. Investment or speculation.
Now,
No, maybe, no, sort of.
how do I decide which is which?
You ruthlessly apply the 3-question filter based exactly on Graham's definition. Question 1. Did I perform a truly thorough analysis? Do I actually read the 10K filing? Did I check their long-term debt? Do I deeply understand how they make their money? Or did I just buy the ticker symbol?
So if the honest answer is, I bought the ticker because I use their product and I like it, that's a strike.
Strike 1. Question 2. Does the specific price I paid offer a real margin of safety? Is the price significantly below a conservative estimate of the business's actual value? Or did I willingly pay a massive premium just because it's a hot stock right now?
So if I paid 115 times earnings, strike 2.
Strike 2. Question 3.
Yeah.
Am I relying on the actual business results, like consistent earnings and dividends for my return, or am I secretly just relying on someone else coming along and buying it from me at a higher price next month?
So you ask these 3 brutal questions for every single stock or asset you own.
Yes. And if a holding fails any of the 3, even just one, you take a red pen and you label it speculation.
That sounds terrifying, honestly. I feel like a lot of people, myself included, are going to have a lot of red ink on their spreadsheets.
They absolutely will. And that is exactly the point of the exercise. You don't necessarily have to panic and sell them all immediately, but you desperately need to see the reality of your situation. Look at the final ratio. If you're at a designated retirement account, the money you actually need to survive on in 20 years is 80% labeled speculation in red ink. You are in extreme danger. You are driving 100 miles an hour down the highway without a seatbelt.
So the ultimate goal is to consciously shift that ratio. Move the serious, life-sustaining money into the investment bucket. Thorough analysis, safety, adequate return, and actively keep the speculation bucket small and isolated.
Exactly. Graham's goal with this entire book is not to make you a boring person. His goal is to keep you solvent permanently.
I love that. His goal is to keep you solvent permanently. Before we wrap up, is there anything else people should chew on?
There is a brilliant quote from chapter 20 that I think perfectly sums up this entire mindset. Graham writes, "You are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right."
That is the absolute essence of the intelligent investor, ignoring the madness of the crowd, looking strictly at the hard data, and genuinely knowing the difference between a gamble and an investment.
It really is the foundation of everything.
This has been a fantastic deep dive into literally just one definition. And we still have 13 more lessons to go in this series. We haven't even touched Mr. Market yet, or the difference between the defensive and enterprising investor, or the actual valuation formulas.
We have only just scratched the surface. But this foundation, this bright line definition, is what every single other chapter is built upon. If you don't get this mental model right first, none of the other chapters will save you.
Absolutely. So for the listener, do the audit this week. Be brutally honest with yourself. Are you just counting to 3, or are you actually doing the work?
It is the most profitable question you will ever ask yourself.
That was lesson 1 of 14 on the intelligent investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.